All right. Enough of that. Got to get to it. How you doing, friends? This is 0 days to expiration, the final hour. Zero days to what? The final hour of what, Ernie? It is the final hour of options expiration on the SPX index or the E-mini futures, or just about any other index that you choose, but we choose to look at the S&P derivatives. They seem to have the most opportunity available. Of course, you could do the NASDAQ, the NDX. That would be nice. The liquidity is a little lower on that, and the volatility is way up there. And these days, the SPX has plenty of volatility, so we stick with that. It is the most tried and true method, and it happens 5 days a week, every Monday, Wednesday. All right, hold on a second. 4, 3, Monday, Tuesday, Wednesday, Thursday, and Friday. That's 5. Got to reset there. And on that expiration day, if you know anything about options, when they expire, that means the premium that is in the option is decaying at an ever constant rate. Now, these options, they're weekly, so they're only about 8 days old. You can get them about 8 days out if you want. You can get them 4 days out. You can get them. We choose to get it on the day that they are going to expire. And that premium is starting way up here, way up here. And then as days go by, it's going like this, right? Here's 5 days, 4 days, 3 days, 2 days, 1 day, 0. That's what zero's like. You know, you get about halfway down and then 0. Well, that last day presents a unique opportunity because when you compress time like that, you also take something away that is usually a risk with people, and that is price movement. So the price can only move so much in a day as it compared to 8 days or 4 days or 3 or even 2 days on that last day. And we choose to take this trade somewhere around just before noontime, between 10 and noon. And so now you're talking about 4 hours for price to move, but decay that's happening like that. So that presents a unique to profit. So that's all good. Let's see, do I have any coffee left? It's not a commercial. Death Wish Coffee, best coffee in the world. Also the strongest coffee in the world. Keeps me going. Yes, I've had too much coffee today. Today has been an interesting day. It was a relatively subdued day compared to others. We're currently in the midst of what I would call a bear market rally, which is in the midst of a bear market. So within bear markets, you often have these rallies that happen spontaneously, sometimes just out of the blue, and they're usually strong and violent, and then they go up really hard and fast, and it gets everybody wondering, is this it? Does this mean the bottom? Are we at the bottom? Hey, we at the bottom? No. Hey, bottom? No. We're not at the bottom, but it gets everybody excited. Everybody starts wondering, are we at the bottom? But I think right now, everyone's coming to the conclusion that, hey, we ain't near the bottom. It ain't happening. So we do have a long ways to go to find that bottom. That bottom, or that period or place of capitulation when everybody just gives in and says, oh, that's going to be the bottom. We're not there yet. It's surprising that we're not there yet, considering how much pain has been induced from this bear market. And it's probably going to get worse. Now, I said induced pain. What I meant by that was, yes, there is somebody inducing the pain, actually causing the pain. And it's not just somebody. It's a combination of a whole bunch of politicians and this rogue group that they call the Federal Reserve and their 400 PhD level economists who are supposed to be the smartest people in the world that can't find their ass from their elbows are actually causing all this pain. And they're doing it on purpose. And Jerome Powell even said so because he's afraid of inflation spinning out of control. inflation spins out of control, and then we're all in deep doo-doo. Now, we know that inflation is really the way, it's sort of like the hidden tax. That is what monetizes debt. But when inflation gets, now, normally you have inflation, it's relatively small, get it around 2% or so. That's just enough so that you can't be, you basically, you're the frog in the boiling pot of water. At 2%, you don't feel the water getting warmer, but it is. But that 2% actually helps monetize the debt. It is the hidden tax that you pay every year. You're paying slightly higher prices. That is what is monetizing the debt. Now, when inflation expands, it starts exposing the frauds for what the government and the Fed really are. And that's because our prices are going up much higher, and we're realizing that, man, this just ain't a good deal. No way. And the Fed and the government realize that because they know once you get that idea in your head, you ain't going to vote for them anymore, and their power is gone. So they're doing everything they can to try to stem that inflation, even if it means kicking you out of your job, kicking you out of your house. That's the sacrifice you must make for governmental power. There you go. I just gave you a lesson in economics, and it is 100% true. Let's see if monetization continues on this. All right, let's see here. So what we do here at Zero DTE is more than just trade the Zero DTE. I mean, that is like what we do. That is one of the it is the mechanism that we choose to play in. That is the landscape from which we think that we can make the most money. But that's not precisely what we do here at Zero DTE. This is not an alert service, although we trade every day, members trade every day. I trade, people follow my trades, but not always my trades. Sometimes they make up their own. This is an educational service. It is a coaching and mentoring service. I am here to help you become a professional trader. Now you might think, well, do I need to become a professional? I mean, does that mean I'm going to go to work for some institution or something? No. You're going to be or act like a professional trader for one very good reason. You're taking your hard-earned money. And just think about what money actually is, what it represents. You work hard, you go to school, you study, you come up with great ideas, you make things happen, you provide value. And that, in exchange for that hard work, they give you money. So that money represents you, all of your efforts. Everything that is about you is now, well, not everything, but for some people it is. But a good portion of your effort is now contained with there. Now you're able to then take that and then purchase things, live a good life, buy luxuries, save for your retirement, buy gold. Do that, right? That's your money. And so now you're coming to a service, no matter what it is, and you're going to put your worth, your value to work to try to increase its value, right? I mean, it seems kind of wanky. It's almost like going to a slot machine or a casino or something. I think I'm just going to let it ride, but no. If you know and you have an edge and you're disciplined, you have the right process, the right attitude, you can actually put your money to work and make it grow and try to stay ahead of this inflation juggernaut. Now, when you do that, think about this. That's you putting it into the fire, right? You have to have reverence for that money because that's you. That is your value that you've created. Why would you not have reverence for that money? Why would you not be so ultra careful about what you do with that and only take the smallest risks for potentially the largest outcome? Just like anybody that goes into business or any venture capital investing in other businesses or an entrepreneur that's creating a business or a real estate investor that is looking for the best possible way to leverage his money to make the most money. Or you put in the work for your education and your skill so that you can create some kind of life for yourself with an employer and good employment. And I mean, that is your risk that you're taking. It's a relatively small and it's transferable, right? So why don't you do the same thing with your money? Well, that's what we teach you here at Zero DTE, is how to have reverence for that money by showing it the respect that it deserves, which is essentially showing yourself that respect, and learning how to handle it correctly, how to best use it, how to create an effective process, get skilled, find some sort of mastery in the fundamentals of what you do to try to increase the value, to multiply that value. And that's what we do. That's what this service is all about. So when you come here, you're not coming to an alert service. And we have alerts, we do trades, but you're going to learn how to become a professional and how to handle that money in a professional way. No different than if you were with a big trading firm, a prop firm, an institution, a fund manager, whatever it is. You will be every bit as skilled and able as any of their traders when you come here. All right. Now, let's first do a roll call. All right. So everybody that's out there, say hello. Of course, Dan is first on the list again. He should get an award for that. Brent is here. Nice to see you. Varbale. Is that how you say it? Varbale or Vabal? I don't know. It's a cool name. Hans, nice to see you again. Hans is a regular, as is. Let's see. We have Mobaba. I have glasses on, but my glasses suck. Mobile Joel. I know who it is. I'm just trying to, make sense of the name, and it's kind of cool. It's just, we have Paco. Nice to see you. And I2IS. I'm speaking to him or her. So, yeah, I think I'm speaking to a lot of people. And quite frankly, I talk with these people every day. The people that are coming to us and finally recognizing that, man, finally, a service that doesn't look like a scam, a service that is just interested in just pushing alerts at us. Finally, some service that actually takes an interest in what we need to know. The other difference here is that it is a coaching and mentoring service. So what does that mean? It means that you're going to get coached and mentored. I have both group coaching and mentoring as well as individual coaching. And you're going to get it from somebody who has been there and done that. I've got more than 40 years in industry. I have coached and advised everybody from the chief executives of Fortune 5s to the directors and mom and pops. And everybody in between, and trained dozens and dozens of traders and hundreds of people, maybe hundreds in the C-level suite and business. I've been there. I've been in the financial industry and financial technology industry for a good portion of that time. I have been a consultant and advisor, trusted advisor to these people. I have run a hedge fund. I have also been the lead trader in a family office fund, or the chief investment officer. And I've been an institutional trader. I know what it takes to become a professional and be a professional and act professional. I know what it takes to be and stay motivated. I know what it takes. And that's what I offer to you. All right, back to the roll call. FF wants to know, what is your edge entering the markets? Well, we have a number of edges. The first one that I spoke of earlier is this premium decay. There is a fundamental mispricing of options, and we take advantage of that. The other is our analytical methods and how we see the market, which is unlike anything that you do in technical analysis. I've also been a quantitative, and I understand that these technicals, they're all looking at just little slices of the market, and it's always backloaded or averaged over a small period of time, and that's supposed to tell you where price is going. It's completely ineffective. We only use volume profile, and the memory that's in the market to determine in real time where the structures of the market are. So that's the second edge. Third edge is our asymmetry and our outlook on how we put on asymmetrical trades. Small risk, large reward has a positive expectancy. Our return distribution is a positive skew with long tail, fat tails. What does that mean? That means that you risk very small for making potentially very large returns. And so that does something for you. A couple of things that give us edge. One of them is that positive expectancy is certainly important, but even more important is the very small drawdowns. Get very small drawdowns and very little volatility in your equity. So that produces a very calming effect, for one. And the other is because you're never really worried, and we have defined risk, you're never really worried about the downside because you've already defined the downside. You are only worried about how much money you're going to manage to take from the market. Your whole attitude is different. You have released and shed that anxiety that exists, that panic that exists with most other types of high probability strategies, which have huge back end risk and negative expectancy. So that is a huge advantage from a psychological point of view. You're no longer fearful of the market. You're calm, you're cool, you're collected. You can make clear, rational decisions. And that alone right there trumps just about every other edge that I could possibly imagine. But that is the edge that you have in the market when you trade like a professional. I've been alongside professional traders, hedge fund managers, industry titans. All of them play by this rule of asymmetry: small risk, huge potential reward. Everyone except for retail traders in the market, they go the exact opposite way. They think that high probability translates to high returns, and it doesn't. It's exactly the opposite. Yet that is what they are, what is drilled into them from day one. They believe that a high probability strategy is the way to riches, when in fact it is a canard. Now, I don't just say that because it's just an observation I made, right? It seems that way, right? No, I've been involved in this industry from the very beginning. I helped the first online brokerages get online. I was the principal person for putting the brokerages online and dealing with the management of those brokerages. I've worked for and consulted to just about all the major brokerages there are. They all have exactly the same goal. And it is antithetical to your goal. I mean, your goal is to make money. That's not their goal. Their goal is to make you push the button. That's it. They don't give a darn whether you make money or not. That is their goal. And if you play their game, you're going to lose. And that's what most retail traders do. They play the game of the broker. They submit to the broker narrative. We recognize what it is. And you think, well, how do you know this, Ernie? Because I help perpetuate it. I literally worked for the brokers to help them perpetuate that technology, that business model. And you see it every day in how companies transact. I mean, that's what it's all about. Push the button, baby. That's what we like. More transactions. Trade lots of little transactions. Get that pop and rock up there. Poop, 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 poop. Thank you very much. That's what it's all about. So if you want to know what our edge is, that is our edge. The other edge is that you have me that has been there, done that, understands what the market's all about and how to condition you to fight that. Fight for yourself. Have respect and reverence for your money and for yourself. All right, let's see. Long or short? I don't know what that means. Yes. The answer to long or short is yes. Vadam's here. How you doing, Vadam? And Don H. Yes. 0 dash DTE. You must have that dash. If you don't have that dash in between the 0 and the DTE.com, then you have trash. All right. That's a little brazen, but hey, it's fun. Sounds good. How you doing, Donald? And BG Systems from Germany. How you doing? And Alan Sturber's here. Nice to see you, Alan. Imaginary number formula won't let me do AN equals sign. Oh, he's speaking like speaking some sort of cryptic thing. Don't make me think too much. See, Hans is throwing a shout out over to BG. All right, I'm glad you guys are having fun back there. Well, thank you. BG, wash hands. Oh, he's probably trying to get an emoji to come up, but I don't see it on my side. And Stevens Mortgage, how you doing? Do you mostly buy last hour index butterflies? No, we hardly ever buy last hour. And Paco completely agrees. Therefore, Paco gets the gold star for today. Anybody that agrees with me. But let's go back to this. Do you mostly trade or buy the last hour butterflies? Now, let me just say that every hour of the day, there are different opportunities. And so you need to understand a lot of different things about what is the best type of trade or position and width of fly to put on at those various hours based on your knowledge of that premium decay, also where the volatility is going up or down. That will affect you. As you get closer and closer to the final hour, the fluctuations in volatility don't matter as much, but they matter more when you have narrower flies. So in general, you're trying to put on wider flies earlier and narrower flies later, but there's a limit to all of that. So do we trade the final hour? You know, we did an experiment where we did 100 trades here online, and the first 50 went fantastic. The second 50, not so much. We just went sideways for the entire way. And it was an experiment. We wanted to see if we could, in fact, create a strategy that was focused strictly on that final hour. And it is tough. It is very tough. Not keeping with the precepts of what I want, what I think is important in any strategy, and that's having that asymmetry. That's what's most important to me in controlling your risk. It is a difficult thing to do, so we don't do it. Now, we are exploring other strategies other than our symmetrical fly idea. So we put on symmetrical flies. We put on symmetrical unbalanced flies. We also have the pattern day trader hack, which is a kind of hedging, and also gamma hedging. So those are things that we employ in the service, and we are looking at other strategies. But in terms of the hour to trade, I find that one of the most opportune hours with the SPX is probably between 10 and noon, 10 a.m. to noon Eastern time. And you could also trade the E-mini, which affords you the ability to trade outside of market hours. So the session on the E-mini starts at 6 o'clock the previous night. Last year, when we were doing the E-mini exclusively, we put on lots of trades that started at 9, 10, 11 o'clock at night, and then sometimes took them off in the early morning and collected a nice premium. Or you might use the E-mini to put on or find an opportune time to put a trade on right after a market or an economic report comes out, which is usually around 8:30 in the morning. So again, those are different ideas that you have in terms of time. All right. All right. Giannis, nice to see you. Hi, Ernie. What happens if market maker won't close your 0 DTE position? What does the market maker have to do with closing your 0 DTE position? Are you saying that you try to close it and you can't get the limit price that you want? So why would that be? Why would there be a situation that you couldn't find buyers on the other side to close it? You know, it's not going to be the market maker. They're trying to match you up with somebody. But if there's no other entity or counterparty to take your trade, then there must be something wrong with your trade. Now, there could be a lack of liquidity. Maybe your trade is too wide or out of range, perhaps. It could be that you're trading something that does naturally have less liquidity and fewer counterparties to actually trade with. And so from there, the spreads are too wide and you can't get your price. Or maybe it's just that you're just unreasonably pricing your option. I have never found with the SPX it more difficult than, say, canceling or replacing and changing every 5 seconds on my limit price. Max I've ever had to go is 20 cents. I usually try to get ahead. If price is moving, that's a different story. You can't chase price. So you have to be a little bit more aggressive and proactive in choosing how you're going to lock in your price. Now, there are other ways that you can do it. You could put on a gamma hedge. You could put on a PDT hack, which is basically the opposite trade to lock in price. Now, you may still have the same problem with liquidity and wide spreads and not able to get your price. So again, it's all situational. So, but I've never come across when we're working within reasonable limits that, I mean, look, the S&P is one of the thickest markets on the planet, the most liquidity. The fact that you can't get your price tells me that there's something wrong. Yeah, Han says, always be closing. I'm not sure if that always uh, applies here. It certainly applies when you're, a salesperson, I guess, right? Always be closing. But you're right. I mean, we're always looking to close our trades in an opportune time that is going to uh, lock in the profits that we want and avoid any of that gamma risk that you have near the end of the day. So that's important. All right. Let's see. Good comments. So let's see. I did. I didn't really recommend a trade earlier today. I did put a trade out there that I think some people patterned their trades after. So we can take a look at that and see where that is. Let's see here. I'll have to go to the Discord and find that trade. I didn't put it on myself, but I know others certainly looked at it. There's so many messages. I got to keep on scrolling and scrolling. There it is. All right, let's bring it over here to Flounder and Drown. I mean, Think or Swim. All right. Almost done. All right, let's go to the charts. It's over there. All right, so let me move this over. And this is the trade that I put out there this morning. I put out two versions of it because people were asking me, hey, what's the difference between a credit spread that looks like this and a debit spread? Is there fundamentally a difference? And I said, no, there's really no difference. And then they asked me, well, why? Why is that, Ernie? Why is there no difference between? Oh man, why isn't that? It's like a rubber band. I'm trying to. There we go. Let's move it over here again. So hard to move, think or swim around. I'm just trying to center it and make it nice and wide so it's easy to see. Why can't I do that? There we go. There, that's nice. Okay, so let's open up the price slice so that we can see exactly where. Let's delete this guy here and opened up this one. There's price right there. So this is the trade that I put out there before earlier today, and it looks pretty good. right? It's centered on 3690. This is an E-mini S&P position, so if you were to equate that with the SPX, it would be about 10 points lower on the SPX. So on the SPX, you would probably center it on 3680. This is a 15 wide. Now, I found overall that 15 wide to 20 wide is pretty much my sweet spot for not only success rate, but also the amount of premium that I can collect over time. It might have something to do with the probability of touch, putting on something that is a 1 to 7 to 1 to 8 risk to reward, and having it within that sort of proximity seems to work. Now, it's working in this market. It is my highest grossing strategy that I put on, or for in terms of risk to reward. But whether or not it's going to work in all markets, I don't know that. But I am noting that in the last 100 trades, this has definitely been the best combination. Taking that trade somewhere between 10:30 and noon, 15 wide with a risk to reward between 7 and 8. So take that home and smoke it. So this trade currently had a $1.75 entering at the time that I was looking at it and specifying it. And right now it is worth a little over $200. All right, so we've got about 125% return so far. You always have to make sure with the E-mini that you include the commissions, because the commissions can be quite high, so you're not getting a false idea of what you're up against. So $1.75 on the E-mini isn't $175. It's actually half of that. So I misstated the actual return right now. So let's do that over again. So 175 divided by 2 is the actual cost, or 87.50. Right, and so the current unrealized gain is 180. So 180 divided by 87.50. That's a 205% return right now. And if we're lucky, it will move closer into the center strike. But I look at a trade like this right now from a profit management point of view. We've achieved, let's say, 200, 400, 1/3 of the potential profit in this. Now, the potential would require us to perfectly pin that trade and be right in the center and bring it right to expiration. There's a very small chance that that's going to happen. It's not, it doesn't mean it won't happen. And we've had lots of pinned trades in the service and even here online, on these YouTubes, live, as a matter of fact. And one time I came within as close as 17 cents of the center. That was the closest I've ever come. Usually I come within a couple of dollars, a few dollars, when we do pin the trade. But today, are we going to pin it? I don't know. We seem to have a lot of trouble getting much lower than this level. So I'm going to say that it's probably not going to happen. And if we held this to expiration, the most that we're going to get is another $80 out of it. If it stays right here, the gamma risk as time goes on, which is the steepness of this profit curve. That's how you can look at gamma risk. That's the steepness of the profit curve. Is significant right now. So there's a lot of sensitivity to price movements. As a matter of fact, we just moved just now, and it went from a $200 unrealized profit to $165, $170, lost $30 in just a couple of tick move. So a trade like this, I would be looking at that from a management point of view. I would box in my profits. And what I mean by that is I say, look, what is it that I've gained for the day? And so let's say that it's $200. I gained $200. What am I willing to give up? When at this time of the day, I'm not willing to give up much more than, say, 33% or 1/3. So I'll set this arbitrary limit that the most that I will possibly give up is, say, $60 on that 200. So I will figure out where $130 is, which appears to be right about here, almost right on the long leg at this time. And so if price moved out to there, I would probably get out of the trade because then it's just a quick move down. And getting out of the trade would mean that I would have to stage my exit strategy and be ready to give it a few cents so that I can capture it, and just in case there's a quick move. But that's what I would do. I would say that's going to be my limit. It's an arbitrary limit. I don't know if it's going to go out there. I'm just saying that if it does go out there, especially with today's price action, I look at this. It doesn't look to me like we're going to go down again. It looks like we're sort of climbing the wall here, and I think that we're going to probably end higher on one of these session nodes here. Probably this one right here, probably at 37.10. That's going to be my guess. What is your guess out there in the chat room for a close? I'm going to put my guess at 37.10, and this is the E-mini S&P. So 37.10 would be about 3,700 even on the SPX. So there's my guess, 37.10. I put it in. AN wants to know what gamma risk is. I'll get to that in a second. Edgar says, I was able to close only the short leg of a vertical put spread because it was already at 0.2 to settle by itself when the market closed. Well, if it's in profit and if it's in the money, yeah, if it's the SPX, you don't have to worry about settlement. It'll just it'll take about a day to do it, but tomorrow you'll see the credit in your account. Or if it doesn't settle inside the profit area or in the money, then you'll see the debit from your account for whatever risk that you took. No, Thang Nguyen, you cannot have two prices. You have to choose one. So he chose the middle or something like that. Okay, 36.95 in the SPX. That's okay. And so I chose, like I said, I chose 37.10 or 3,700 on the SPX. So let's get back to AN's question. What is gamma risk? So gamma, it's a Greek designation, one of the option Greeks, and it is a measure of the price sensitivity to delta. All right, well, that's a mouthful. What does that mean? So delta is price movement. So if the price is moving, the amount that it will move and its relation to the value of your option is delta. So every time your price moves back and forth, up and down, it has a certain delta. When you're very close to the money, that delta is about 1, right? So every dollar that the price moves, so does your option moves about $1. Now, gamma risk is the sensitivity to that price movement. As you move further out from the money, a little bit further away from the money. So in the case of a butterfly, let's take a look at that. In the case of this butterfly, if I were right in the middle here, my delta would be about 1. Well, let's see, right here, delta is about 1 right now, right here. But my gamma risk is very high, and that's because I'm very sensitive to any price that moves up or down. And that is because the profit curve, you can see the gamma risk right in the profit curve. The profit curve steepness right here is very steep. So if I just move, say, right now it's $217. If I move to the center, it's worth another $60. If I move just a little bit over here, it's worth, man, it lost a lot. It lost almost $100. That's gamma risk. That price sensitivity to any move in, well, that's what I just said. It's the sensitivity to price movement. So when that profit curve, which is the purple line, is very steep, then your gamma is very high. As you get closer to the center, see how it flattens out? Then your gamma risk drops a lot. The other thing that will help you out with gamma risk is if you have a very wide spread. So then the profit curve isn't as as hilly. It's more like a dome, right? So narrow spreads near the end of the day have much higher gamma risk. Now, see, gamma risk is really hurting this trade right now. Just a moment ago, it was worth $220. Now it's only worth 160. All right. So does that answer your question, AN? All right. So Dan says 370 for the XSP. Give me max profit. We love max profit. So that's a wonderful thing about using a tool like Thinkorswim or any other options and analytical tool, that you can see that profit curve and you can literally see what your gamma risk is. It's one thing to look at the numbers like it's a dashboard or something, but that's kind of like being on a plane and flying by numbers. You know, who wants to do that? You want to be able to look out the window and see the ground and see the mountain in front of you, right? When you have a tool like this, you know, I'm not sitting here looking at what my potential theta is. I don't care about that, right? I don't care about what the gamma says or the vega being the price sensitivity to the changes in volatility, right? I don't care about that. Now, vega negative is indicating to me that there's upward pressure on price. And that is generally good for a butterfly if you're inside of the profit tent, not if you're outside of it. What that means is when you have negative vega, that means that IV, or implied volatility, is falling. And the reason why it's falling is that price is going up. In general, it did there for a bit. Now it's starting to go down. But I think still the vega is negative, which means that will affect the rate at which that profit curve will fill up your profit tent. So the lower that is, the faster that curve starts going up. But that's an almost imperceptible amount. The only thing that you really have to worry about is your gamma risk, because that's the only thing that you can really control, is where you're going to get out based on whether price is going up and down. Right? Now, theta is the potential additional return that you can get if price stays right here and then expires right there. So if price stayed right here, I have an additional $40 I could potentially make by the end of the day. But right now, that guy's worth about $220, and if I can only make another 30 or 40 bucks, I'd probably be out of that trade, unless I'm willing to gamble and see whether or not price is going to move down to the center strike at 36.90, and that's possible, but I don't think so based on the market structure and the current session POC. I think that it's more likely that we're going to move to the right. So for that reason, I would have been getting out. Right? I'd be looking to get out around here. Now, I could be totally wrong, and then in the last minute, we could move right to the center, and then I give up like $300 or $400 just to save $60. On the other hand, I could be right, and it could move to here, and I could potentially have no profit. For the same move, one move would give me an extra $300. The other move would give me $0. Actually, worse than $0, but a total loss. So it would be $200 minus the cost of my trade. So that's a big swing, right? That's a big swing. So if I were to make that choice right now, that's what I'd be doing. I'd be getting out. All right, so Urban Athletics, how you doing? This is my first time seeing you folks. I just wanted to hear how you choose your strikes and how wide you go. I use stop loss with my trades and go 20. Professionals, I'm sorry, Urban, but professionals do not use stop losses on options trades. If you're using stop losses, that means that you're probably one of those high probability traders. Now, I'm not trying to come down on you, but I'm just telling you that I don't know any professionals that use stop losses. All right. I just don't. You have defined risk. You should use it. All right. You're saying I'm usually entering around noon, but wanted to see what your advice is. See, I don't know what you're doing, so I can't. First of all, I don't provide advice. I'll show you what I'm doing, but I don't know what you're doing. So whatever suggestion I give you may not have the right context for what you're doing. If you're using stop losses, then I'm guessing that you probably have iron condors on and you're doing a high probability trade and you're putting the stop loss because you're super afraid of going to max loss. If you're doing that, that is nothing like what we do. As a matter of fact, we do exactly the opposite. There is nothing in common with what you do and what we do. If you'd like to take our trial, you can go down to the link below and see what it's about. But what you're doing has a negative expectancy. It is perhaps the one of the worst implementations of a zero DTE strategy that I've ever seen. Yet that's what everybody does because they're attracted to the shiny object of high probability profits. That's bull cookies. We don't do that. We do defined risk and never use a stop ever. Now, if we're using stops, it's not to guard against max loss. We're using stops. See, there's a difference. People that are doing high probability strategies are doing what they call risk management. And that's because their risk is so huge. They have asymmetric risks. Their risk is multiples of their potential profit. So that's what they're focused on 100% of the time, and forcing them to put stops on an option strategy makes no sense. We take asymmetric risk the other way around. Our risks are defined and small. Our profits are multiples of our risk. So now, instead of being risk managers, which I call loser managers, we are profit managers. We manage our profit only. As a matter of fact, virtually all of my trades that are on the losing side, well, not virtually, I would say 95% of my losing trades go to 100% loss. Yet my drawdown is still only 3%. That's saying something about the size of the risks that I'm taking. It also says something about the potential profit that I'm taking, because with that risk, I could potentially make 150, 250, 300, 1,000, even 1,500% return on the risk that I take. On the high probability strategy, the max that you're looking for is maybe 5 or 10% of the risk. That's it. Imagine you're going after 10% of your risk that you're taking. I'm going for 1,000% of the risk. In real numbers, it's usually closer to, if you were to put it all and take one person's strategy and up against our strategy, we're generally 20 to 40 times more cost efficient with the money that we use and the profits that we're chasing. 20 to 40 times. Just think about what that actually means. You use 20 to 40 times less capital to make the same profit with our strategy. Along with that comes a completely different attitude that you take in the trading. You're never anxiety ridden, ever. All right, so Rico Majestic, that's a cool name. So what's your net profit in dollars on the year for these final, what does that mean on the year for these final zero DTE trades? All right, so I'm trading currently as our reference account in the room. I'm trading about a $25,000 account. My average return per month right now on that account is about 6% per month. 6%, not 6% of the risk that I'm taking, 6% of the total account. However, I'm never using more than maybe 1 or 2%, well, never much more than 1.5% of my total account value. All right, keep that in mind. Never using more than 1.5% of my total account value, yet I am returning 6% of the total account value per month. I can show you the log if you want to see it. I show it all the time. All right. So this trade just doesn't seem like it wants to go anywhere here. Yeah, we're just hanging out right there. I think it's going to go up. So the question is, so you need a 25K order not to be a pattern day trader account. Yeah, that's pretty much why I'm choosing an account that size. But we can avoid the pattern day trader rule through a strategy that we have. So if you have a smaller account, you can avoid it. And you could trade 5 days a week, no problem, and employ this rule. We just never let a trade go to expiration. Well, we always let our trades go to expiration, but we put on a hedging trade that will lock in the profits and then bring it there. That way, we never get a pattern day trader strike. So you could, in fact, trade a smaller account. The other option is just to trade the futures. If you trade options on the futures, the E-mini S&P, even though the commissions are higher, but that's okay. You can't be a pattern day trader because there's no such rule for the futures. And the advantage you get with the E-mini S&P, the futures contract, the ES, is that you can trade outside of market hours. Let's see. Thanks for that. How large are your losses relative to your wins? Do you have an accuracy percentage of your trades? Yeah, my max drawdown is 3%. Max drawdown 3%. If you want, I'll just show you the trade log. How's that? So here's my log. All the trades. All right. So this is I just switched over to this account a little while ago. My account from last year was actually much better than this, but I don't like to count that in this calculation because last year was an anomaly. You know, the Fed's pumping us money. Any monkey could have made money. I tripled a small account in 9 months then. So now I switched over to this bigger account and I'm trading in this bear market, which is quite a bit different from last year. And this is the performance I've had so far over the past 118 days with 102 trades. My win rate is about 53%. My return is, I'm going into a little funk here. I was as high as 19%. So it is on average about 6% per month. My average winning trade is almost $200. Average losing trade about $140. My largest winner has been 1,100. My largest loser has been 363. All right. My average risk to reward is just about 1 to 9. My max drawdown has been just over 3%, which was right here. Right here was my max drawdown. All right. Some of the more relevant stuff that we look at is my distribution of returns. I have what you would call a positive skew on my distribution with long tail or fat tail winners. So I have a lot of small losses offset by small wins, and then punctuated by lots of big medium wins and outsized wins. Most of my trades are, from a risk to reward point of view, are between 1 to 7 to 1 to 10. That's what you see right here. All right, I think we're coming up here. That's where I think we're going. 3710, that's my number. We don't have any other guesses on what the ending price is going to be. We're getting closer now, so you need to, only 5 minutes left. Your guessing capital is dwindling. Let's take a look at the trade that I had illustrated earlier. I'm not going to say recommended this trade because I really didn't. I put it out there because someone asked about it, where I would have put a trade, and so this is what I said. And then they asked me about, well, what's the difference between that and a iron condor? So I wanted to show them that as well. So if I were to show you the iron condor, I'm going to turn on the iron condor. What that looks like, looks exactly the same trade. It looks like the iron condor actually has decayed faster. But we're right down near the end. There's only 4 minutes left, so it could be a difference in the way the model is calculated. Right here, I'm using the binomial. So that's hard to tell the difference. There's a little point there. Oh, see, it's jumping all over the place, so it's hard to tell. They're essentially the exact same trade. Let's see. Urban Athletics wants to know, would you mind or explain on how your thought process is on your 0 DTE trades and how you structure them? Well, if you show up here every day, you'll get an earful. But essentially, we're looking to make asymmetric trades, symmetrical butterflies that are out of the money with a risk to reward that is anywhere from 6 to 10. So 1 to 6 to 1 to 10. 1 part risk to 6 up to 10 parts reward. The way we place them has something to do with our analysis of the market structure, and all of our analysis, we do not use any technical analysis. It's all done through volume and volume profile, and my unique method of structural analysis. We also try to figure out the market vector through our geo-macroeconomic analysis, usually done in the morning, and from there we can figure out a price vector, the direction and magnitude that we think, and I develop scenarios. Those scenarios are then laid on top of the market structure, and then we figure out different scenarios, and then we model our trades around those scenarios. Once the market opens, then we're looking to put on that symmetrical fly in a place that we think is most opportune to intercept price. There you go. Mr. Mortgage News says, do you sometimes trade more contracts depending on volume, profile, et cetera, or always one contract? It depends on account size. So for the $25,000 account, I may sometimes go to 2 contracts if the price moves away from my target and I still think it's a good trade. I'll add an additional contract to get a better risk to reward, as long as it doesn't violate my max position size, which is around 1.5% for that $25,000 account. For larger accounts, I scale up. So I have a $200,000 account that I trade, but on the $200,000, I never trade much more than 0.75%. But with that allows me to put on sometimes as many as 3 to 4 positions. You might think that is super small. That just is crazy, Ernie. How can you trade so small? Well, great, but I have a 3% drawdown and a 6% return per month. So tell me I'm trading too small. Yeah, I told you it was going to come up here. Ding, 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 ding. Was I right? Was I right? What was the close? We have to go to the fixing price to find out the close. Let's go to here. Let's go to the CM. It's going to go to the CME fixing price. All right. CME, the Chicago Mercantile Exchange, and it will give us the official close of the E-mini S&P. They published it already. It was 3707. 3707. So I missed. Did I miss? Because I said, well, I said 3710. So I was only off by 3 points. That's not bad. I think I won the grand prize today. Did I win? What do I win? What do I win? All right, there we go. And the market's now taking off. It's going up. So hopefully, if in the people in our service, if you had that trade, you took my advice and got out when I had recommended it. That was about 1/3 of the potential profit, which isn't bad. It's about a 210% return on your money. Oh, Jago, you're really late. He guesses 3710 too. Good for you. Yeah. So Tang, you were 36.95 is not bad, but that wasn't 3710 like I guessed. Let's see. We have to go back here and see what other people guessed. Dan Smith had 3,700 for the XSP, which is really 3,710 on the E-mini. Okay. Let's see. Tang had 36.95. Yeah, I'm the winner. Winner, winner, chicken dinner. Oh, so yours was on the SPX. Okay. All right. So we have to add 10 points to it. So you'd be very close. You might actually be the winner then, Tang. If yours was, so yours was 3707 if you add, or 3705. So yeah, that's pretty good. We'll give you the benefit of the doubt. Yeah, I was looking at the E-mini for my pricing. So the pricing difference is about 12 points on the SPX versus the E-mini S&P. All right, that's it. So so now's a good time to join our group. Some people, hey, this is a shameless self promotion, and it's my YouTube, so I can do that. If you'd like to try out the service, go down below, click the 0-dte.com/try for a 4-week trial. Everybody that enters the 4-week trial, Dan was a winner. Cool, Dan. Everyone that enters the 4-week trial gets a personal coaching session from me and get you up and started quickly so you're as productive as possible. If you become a member, you also are entitled to one-on-one coaching. And that's about it. It's a great deal. We've had a bunch of people join this past week. I think just in this past week alone, about 50 people. So there you go. I think we're all done here. I want to thank everybody for showing up and participating, listening to our stuff. And we'll see you next time. We'll see you tomorrow. Peace. Take care. Oh, we need music.